I want you to think about a very simple difference. 10% a year, 13% a year, 15% a year, 17% a year. At first glance, those numbers do not feel dramatically different. They look like small gaps, a few percentage points, a little better, a little worse. But when you add time, those small gaps become large outcomes. That is the power of compounding. Compounding does not look impressive at the beginning. It looks slow, it looks almost boring. For many years, it can feel as if nothing extraordinary is happening. Then the curve bends. And when the curve bends, the person who earned only slightly higher returns for a long period can end up in an entirely different financial world from the person who earned average returns. This is one of the most important truths in investing. Small differences in return become enormous differences over long periods. But there is a second truth that must always sit next to the first. Higher expected return usually comes with higher risk. The mistake people make is that they want the first truth without respecting the second one. They want more wealth, faster compounding, earlier retirement, and market-beating returns. But they do not want volatility. They do not want drawdowns. They do not want tracking error. They do not want the psychological pain of being wrong for a while. That is not how markets work. Markets pay you for bearing risk, uncertainty, volatility, concentration, and sometimes discomfort. So the real question is not how do I get the highest return? The better question is, what is the highest return I can reasonably pursue while still having a system I can stick with through bad periods? That is the question serious investors ask. The S&P 500 is one of the best investment inventions in modern financial history. It gives ordinary people broad ownership in many of the most important companies in the American economy. It refreshes itself over time. Companies that weaken can eventually fall out. Stronger companies can enter the fund structure, makes broad diversification simple and low cost. For many people, owning the S&P 500 or a total market index is enough. It is simple, it is diversified, it is historically powerful, it has produced strong long-term returns despite recessions, wars, inflation, crashes, political crises, and endless predictions of collapse. There is nothing wrong with that foundation. In fact, I think any discussion about trying to beat the S&P 500 must begin with respect for the S&P 500. Do not treat it as weak simply because it is common. A simple strategy that people can hold for decades is often better than an exciting strategy they abandoned during the first major drawdown. But after we respect the foundation, we can ask a reasonable question. Is there a way to tilt a portfolio toward areas that have historically outperformed the S&P 500 while still using ETF structures instead of trying to pick individual stocks? That is what this discussion is really about. Not gambling, not chasing, not pretending anyone can guarantee the future. It is about understanding the trade-off between broad market exposure and factor, sector, or theme exposure. If you invest $10,000 one time and it compounds at 10% for 30 years, it can become a very meaningful sum. But if that same 10,000 compounds at 13%, the ending number can be much larger at 15%. Larger still at 17%, it becomes dramatically larger. And if you are adding money every month, the gap becomes even more important. This is why people are attracted to the idea of beating the S&P 500. Not because a few points matter in 1 year, because a few points sustained over decades can change retirement. It can change how long you work, it can change how much optionality you have, it can change how much you can give, spend, invest, or pass on. But the key word is sustained. A higher return for one lucky year means very little. A higher return sustained for decades is extremely valuable, and sustaining it is the hard part. That is why we must be careful. Past performance does not guarantee future performance. An ETF that beat the S&P 500 over the last 10 years may underperform over the next 10. A sector that led one cycle may lag the next. A theme that looks inevitable may become overvalued. Momentum can reverse. Technology can stumble. Defense can be politically pressured. Semiconductors can be cyclical. Growth stocks can suffer when rates rise. The investor who ignores these risks may buy the right product at the wrong time, or buy too much of it, or panic when it behaves exactly as a higher risk asset should behave. So the goal is not to say these ETFs are magic. The goal is to understand what they are, why they have outperformed historically, what risk they add, and how a disciplined investor might think about them. Let us start with the basic structure. An ETF is a fund that trades on an exchange like a stock. When you buy one share of an ETF, you are buying exposure to a basket of assets. The S&P 500 ETF gives you exposure to 500 large companies. That is powerful because you do not have to pick every company yourself. If one company weakens and eventually no longer belongs among the largest and most important companies, the index mechanism can replace it over time. This is one reason the S&P 500 has been so durable. It is not a static list. It is a living representation of large American business. You get exposure to Apple, Microsoft, Nvidia, Amazon, Tesla, McDonald's, and many others. But you also get automatic rebalancing through the index rules. That structure solves one of the biggest problems ordinary investors have. They do not know which company will survive for decades. An index fund does not require them to know. But if you want to try to do better than the broad S&P 500, you usually have to accept less breadth or a different tilt. You might tilt toward growth, you might tilt toward technology, you might tilt toward defense, you might tilt toward momentum, you might tilt toward semiconductors, you might tilt toward the Nasdaq 100. Each tilt changes the return profile. It may increase upside. It may increase volatility, it may create concentration risk, it may perform extremely well in one environment and badly in another. That is the trade. There is no free lunch. The first example is the SP 500 growth style. A growth ETF such as Vanguard SP 500 Growth ETF focuses on the growth companies inside the SP 500 rather than owning all 500 companies in the same broad way. Growth companies are companies expected to grow earnings, revenue, or cash flows faster than the broader market, in strong expansionary periods, especially when technology and scalable business models are leading. Growth can do very well. The logic is clear. If the future cash flows of a company are expected to grow faster, investors may be willing to pay more for those cash flows. When rates are favorable and earnings growth is strong, growth stocks can lead, but growth does not always win. Value stocks can provide ballast in different environments. Slower growing but cheaper companies can protect capital in downturns. Dividend-oriented companies can behave differently. When interest rates rise, growth stocks can suffer because their expected cash flows are often further in the future, and higher discount rates reduce the value of those future earnings. So when you buy a growth ETF, you are not simply buying a better SP 500, you are buying a version of the SP 500 with a specific bias. That bias can help or hurt depending on the environment. The source document notes that this type of fund has performed strongly over the last decade, though. In that period, the broad SP 500 itself also did very well. That is a useful reminder. Sometimes a tilt beats the market dramatically, sometimes it only edges it out. Sometimes it lags. The purpose of a growth tilt is not certainty. It is exposure to the part of the market that may compound faster if the economic environment rewards growth. The second example is technology inside the SP 500. A fund like XLK focuses on technology companies in the SP 500. It does not own all 500 companies. It concentrates in the technology sector. This concentration is the reason it can outperform. It is also the reason it can underperform. Technology has been one of the great engines of wealth creation. In recent decades, software, semiconductors, cloud computing devices, digital advertising, artificial intelligence, and platform businesses have produced enormous profits and market capitalization. When tech is leading the economy, a tech ETF can outperform the broad market because it is more concentrated in the winners. But concentration always cuts both ways. If technology valuations become extreme, or regulation increases, or earnings disappoint, or rates rise, or spending slows, a tech-heavy ETF can fall harder than the SP 500. The investor must understand that you cannot look only at the upside history. You must ask whether you can hold through the downside behavior. If you buy a tech ETF after years of outperformance, you should expect volatility. You should expect periods when people say technology is dead or overvalued or broken. You should expect drawdowns if you sell during those moments. Then the long-term return history does not help you. The fund can only work for you if your behavior allows it to work. That is true of all investing, but especially true of concentrated investing. The third example is aerospace and defense. This is a very different kind of exposure. Defense companies are tied to military spending, aerospace systems, missiles, satellites, cybersecurity, contractors, and government budgets. The reason this area can be attractive is that defense spending can be less economically sensitive than many other industries. If there is a recession, governments do not automatically stop spending on defense. If geopolitical tensions rise, defense budgets may increase. If military modernization becomes a priority, contractors may receive long-term demand that gives the sector a different economic driver from consumer discretionary companies or some cyclical businesses. But defense also raises moral questions for some investors that matters. Investing is not only financial, it also has to make legal sense and moral sense for the person investing. A defense ETF may make financial sense for someone who wants exposure to government spending and geopolitical risk. It may not make moral sense for someone who does not want to profit from weapons, military systems, or conflict. No one else can answer that for you. A good investment for one person may be inappropriate for another because values are part of the decision. The important thing is to be honest. Do not pretend morality does not matter if it matters to you. Do not pretend a sector is wrong for everyone because it is wrong for you. Understand the exposure, then decide whether it fits your system. From a portfolio perspective, defense can behave differently from pure technology. It is tied to budgets, contracts, long cycles, and geopolitical priorities that can create resilience, but also dependence on government policy and contract execution. Again, no free lunch. The fourth example is momentum. A momentum ETF such as SPMO focuses on companies with strong price momentum inside the SP 500. The idea is that companies that have been rising strongly may continue to rise for a period because trends can persist. Momentum is a real phenomenon in markets, but it is psychologically difficult. It feels simple when it is working. It feels dangerous when it reverses. A momentum strategy buys what has already been strong. That can sound like chasing, and sometimes it can become chasing if misunderstood. But systematic momentum is not just buying because a chart looks exciting. It is a rules-based process that selects securities based on measured momentum and rebalances over time. The advantage is that it can capture powerful trends. The risk is that momentum can reverse quickly, especially during market rotations. A stock or sector that led the market can fall sharply when leadership changes. If the fund rebalances too slowly, it may hold yesterday's winners into today's reversal. If it rebalances too often, turnover and tax effects can matter. A momentum ETF can outperform for long periods, but it is not the same as broad passive ownership. It is a factor strategy. That means the investor must accept factor cycles. Momentum can have bad periods. Value can have bad periods. Growth can have bad periods. Small caps can have bad periods. Every factor has a winter. If you abandon the factor during its winter, you will not receive the long-term premium if it appears. So again, the issue is not only what to buy, it is whether you understand what you own well enough to hold it appropriately. The fifth example is semiconductors. This is the most explosive example in the source document. A semiconductor ETF such as SMH gives exposure to companies involved in chips and semiconductor equipment. These companies are tied to phones, cars, artificial intelligence servers, data centers, military equipment, medical devices, industrial automation, and much more. Semiconductors have become the brains and nervous system of the modern economy. If AI grows, chips matter. If data centers expand, chips matter. If vehicles become more electronic, chips matter. If defense systems become more advanced, chips matter. If cloud computing, robotics, and automation expand, chips matter. This is why semiconductors have had such extraordinary performance in recent years. But semiconductors are also cyclical. They can experience booms and busts. Capacity gets built, demand surges, inventory cycles occur. Export restrictions matter, geopolitics matters, customer concentration matters, capital expenditures are enormous. Valuations can become stretched. This is not a low volatility asset class. A semiconductor ETF can outperform dramatically, but it can also fall dramatically. The investor must understand both. If you buy SMH or a similar fund because it averaged extraordinary returns over the past decade, you must not assume the next decade will look identical. The question is whether the secular demand for chips remains strong enough to justify the risk, and whether the price you pay gives you a reasonable chance of good long-term returns. The AI boom may continue. It may be real. It may transform industries, but even real revolutions can have overinvestment periods. The internet was real in 1999. Many internet stocks were still bad investments at the wrong price. That is one of the great lessons of markets. A true story can be overpaid for, so with semiconductors, the framework should be both optimistic and disciplined. Optimistic about the role of chips in the future, disciplined about valuation, allocation size, and volatility. The bonus example is the Nasdaq 100, often represented by QQQ. The Nasdaq 100 includes the largest non-financial companies listed on the Nasdaq exchange. It is heavily tilted toward technology and growth, but it is not a pure technology fund. It has been one of the most powerful broadish growth vehicles for many years. The advantage is that it gives exposure to large, innovative, dominant companies. The risk is that it is more concentrated and volatile than the SP 500. When markets rise, QQ can rise faster. When markets fall, it can fall harder. This is the trade. Investors often like the upside but underestimate the downside. They look at the long-term chart and say, I want that return. Then the fund drops sharply in a bear market, and they discover that wanting the return and tolerating the path are different things. This is why I always emphasize temperament. The best portfolio is not the one with the highest theoretical return. The best portfolio is the one with a strong expected return that you can actually hold. If QQQ or XLK or SMH causes you to panic during a decline, then the allocation is too large or the product is wrong for your temperament. If you can hold it as part of a diversified plan, it may have a role. Sizing is everything. Now let us step back from the specific ETFs. The source document is built around the idea that even slightly better returns can create much more wealth. That is true. But the real challenge is not identifying funds that beat the SP 500 in the past. The real challenge is building a strategy that gives you a reasonable chance of participating in higher growth without destroying yourself through bad behavior. This is where AB and BTD come in. Always be buying. Buy the dip. These are simple phrases, but the principle is important. If you are a long-term investor and you own assets you truly believe have long-term value, then market declines should not automatically scare you out. They should make you ask whether the asset is now cheaper relative to long-term value. When markets fall, most people feel danger. Disciplined investors see both danger and opportunity. In 2022, when the market fell sharply, a long-term investor with cash reserves and emotional discipline could buy assets at lower prices. In 2020, during the rapid crash, the same was true. In 2008, when the market collapsed, The opportunity was enormous for those who had liquidity, courage, and a long time horizon. But this is easy to say after the fact. It is very hard in the moment. In the moment, markets are falling for a reason. The economy looks bad. The news is frightening. People are losing jobs. Analysts are cutting forecasts. Friends are saying they are selling. The mind says, wait until it is safer. But safer usually means higher prices. That is why always be buying is powerful as a behavioral rule. It prevents the investor from making every decision based on fear. If money is automatically invested every week or every month, the system continues whether the mood is good or bad. When markets rise, you buy. When markets fall, you buy. If markets fall aggressively and your financial foundation is strong, you may buy more. That is, buy the dip. But there is an important condition: you need cash reserves. You cannot buy the dip if you spent everything. You cannot buy the dip if you have no emergency fund. You cannot buy the dip if you panic because you invested money you need next month. You cannot buy the dip if your allocation is too aggressive. This is why personal finance and investing cannot be separated. The source document emphasizes having cash reserves so you are not forced to sell when markets go down. That is essential. A person with no emergency fund cannot be a strong long-term investor because life may force him to sell. A person with high-interest debt is already compounding in reverse. A person who invests every dollar and has no liquidity may be fragile. So before chasing higher returns, build the foundation. Emergency fund, no toxic debt. Consistent income, reasonable expenses, then invest. And when you invest, understand that crashes are part of the system over long periods. The market has experienced many recessions and many crashes. They are not exceptions. They are recurring features. If you are shocked by a crash, you did not understand the market. A crash is not pleasant, but it is not abnormal. The correct question is not whether crashes will happen. They will. The correct question is whether your system will use them or be destroyed by them. This is where most investors separate themselves. Some people sell during panic and lock in losses. Others keep buying and improve long-term returns. The same event creates opposite outcomes because the systems are different. Now, how should one think about building a portfolio with these ETFs? I would not think in all or nothing terms. One mistake is saying the S&P 500 is enough, so I will never consider anything else. Another mistake is saying these ETFs beat the S&P 500, so I will abandon the S&P 500 entirely. Both extremes can be wrong depending on the person. A more balanced approach is to use the S&P 500 or total market as a core and use satellite positions for higher growth tilts. Core and satellite. The core provides broad diversification and stability. The satellites provide exposure to areas with higher return potential but higher risk. For example, a person might keep most of the portfolio in broad market funds and allocate a smaller portion to technology, semiconductors, Nasdaq 100, defense, or momentum depending on beliefs, risk tolerance, and time horizon. The exact allocation is personal. A younger investor with high risk tolerance and a long time horizon may hold more growth exposure. An older investor near retirement may want less volatility. A person with unstable income may need more cash and less concentration. A person with strong income and high savings rate may tolerate more risk. There is no universal answer. The principle is that the portfolio must fit the life. Do not copy someone else's allocation without understanding their income, age, temperament, taxes, liabilities, goals, and time horizon. A portfolio is not just a list of tickers. It is a tool designed for a specific person. If the tool does not fit the person may not use it correctly. That is why blind copying is dangerous. Now, let us examine the risks of trying to beat the S&P 500 through ETFs. The first risk is concentration. XLK and QQ are heavily tilted toward large technology companies. SMH is concentrated in semiconductors. PPA is concentrated in defense and aerospace. SBMO concentrates in momentum leaders. VOOG concentrates in growth. If these areas underperform, the portfolio may lag the S&P 500 for years. That can happen. The second risk is valuation. The best company or sector can be a poor investment if bought at too high a price. Expected return depends not only on growth, but on the price paid for that growth. If investors already expect perfection, future returns may disappoint even if the company performs well. The third risk is volatility. Higher return assets often come with deeper drawdowns. If you cannot tolerate the drawdown, you may sell at the bottom. The fourth risk is recency bias. Investors often buy what has done well recently, assuming the same trend will continue forever. Sometimes it continues. Sometimes it reverses. The past decade was very favorable for technology and semiconductors. The next decade may still be favorable, but it may not produce the same returns. The fifth risk is strategy drift. A person starts with a plan, then changes it every time performance changes. They buy growth after it outperforms, then sell it after it underperforms. Then buy value after value runs, then sell again. This destroys returns. A strategy only works if it is held through its full cycle. The sixth risk is overconfidence. Watching a video about ETFs can make the decision feel easy, but investing is not easy. Markets are humbling. The moment you believe you have found the perfect way to beat the market tends to teach you something. Humility is a risk management tool. Now, despite these risks, it is rational to study market. Beating ETFs. Why? Because broad markets are made of sectors, styles, and factors. Over long periods, some parts of the market create more wealth than others. Technology has created enormous wealth. Semiconductors have become strategically important. Defense spending can be resilient. Momentum can capture persistent winners. Growth can outperform when innovation and earnings expansion are rewarded. Nasdaq-style exposure can concentrate in many of the companies driving modern economic change. These are real ideas. They deserve consideration. But real ideas must be placed inside a durable system. That system should include several rules. First, never invest money you need in the short term into volatile assets. Second, maintain liquidity so you can avoid forced selling. Third, keep costs low. Fourth, diversify across enough exposures that one mistake does not destroy the plan. Fifth, rebalance when allocations become too extreme. Sixth, understand the reason you own each fund. Seventh, buy more during downturns only if the long-term thesis remains intact and your foundation is strong. Eighth, do not assume past performance will repeat. Ninth, match the strategy to your emotional tolerance. 10th, think in decades. Those rules are more important than the ETF list. The list may change, the rules endure. Now, let us return to the compounding math because that is the emotional center of the argument. If you earn 10% for 30 years, the outcome is good. If you earn 13%, the outcome is much better. If you earn 15 or 17%, the outcome can be extraordinary. But high returns are not only about selecting a higher return product, they are about avoiding the behaviors that interrupt compounding. Selling after a crash interrupts compounding, paying high fees interrupts compounding. Holding too much cash for too long interrupts compounding. Taking on high interest debt interrupts compounding. Chasing a hot theme and abandoning it after a loss interrupts compounding. Overtrading interrupts compounding. Taxes can interrupt compounding. Lifestyle inflation can prevent contributions, which interrupts compounding. So if someone asks how to retire 10 years faster, the answer is not only to buy higher return ETFs, the answer is to increase the compounding engine from several directions: earn more, spend less than you earn, invest. Consistently use tax-advantaged accounts, keep fees low, avoid panic selling, buy during downturns. Hold productive assets, consider carefully selected higher growth tilts if they fit your risk profile. That is the full system. The ETF is only one part of it. This matters because people often focus on the most exciting lever and ignore the boring ones. A person wants SMH because of the historical return but still has credit card debt. A person wants QQQ but has no emergency fund. A person wants to beat the SP 500 but invests inconsistently. A person wants higher returns but sells during every downturn. That will not work. The sequence matters. Foundation first, then risk, then optimization. That is the correct order. If your foundation is weak, higher risk, ETFs can hurt you more than help you. If your foundation is strong, they may be useful tools. That is the difference. In the source document, the speaker warns not to blindly trust a person on YouTube. That warning is important. No one should take a fund list and treat it as a command. A fund list is a starting point for research. Look up holdings, look up expense ratios, look up concentration, look up drawdowns, look up turnover, look up sector exposure, look up historical performance across different market environments. Ask how it behaves in recessions. Ask how it behaves when rates rise. Ask whether it overlaps with what you already own. If you already own the SP 500, you already own many of the companies inside these ETFs. Buying XLK or QQQ or SMH may increase exposure to companies you already hold. That may be intentional, but you should know it. Overlap is one of the hidden risks in ETF investing. A person may think they are diversified because they own many funds, but all the funds may hold the same mega-cap technology names. That is not true diversification. That is disguised concentration. Disguised concentration is dangerous because the investor feels safer than he actually is. Always look under the hood. Do not only count the number of ETFs, count the economic exposures. Now let us think through each fund type as a role in a portfolio. SP 500 growth can be a tilt toward companies expected to grow faster. Technology can be a stronger tilt toward the sector that has dominated the modern economy. Defense can be a geopolitical and government spending exposure. Momentum can be a rules-based trend, following factor within the SP 500. Semiconductors can be a concentrated bet on the chips powering AI, data centers, electronics, and modern industry. Nasdaq 100 can be a broad growth and tech-heavy basket of large non-financial companies. None of these roles is identical. That is useful, but many are correlated. Growth tech, semiconductors, and Nasdaq can all be sensitive to similar forces: rates, valuation, earnings growth, AI expectations, liquidity, and risk appetite. Defense may be different. Momentum may rotate depending on what is leading. The portfolio effect depends on how these exposures interact. That is why allocation should be deliberate. You might decide that the SP 500 remains the core because it is broad and self-cleaning. Then you might add a modest amount of QQQ for growth, a smaller amount of SMH if you strongly believe semiconductors remain central, maybe a defense ETF if it fits your financial and moral framework, maybe a momentum ETF if you understand factor rotation, but you would not necessarily put everything into the highest return historical fund just because the chart looked best. That is backward. A disciplined investor looks forward while respecting history. History provides evidence, not certainty. Now, there is another important point about retirement speed. Higher returns can help you retire sooner. But volatility can delay retirement if you need to withdraw during a bad period. This is called sequence risk. If you are young and accumulating, volatility can be your friend because you are buying. If you are near retirement and withdrawing, volatility can be dangerous because you may be selling into declines. So the same ETF can be appropriate for one person and inappropriate for another. A 30-year-old with stable income may tolerate a higher allocation to growth and semiconductors. A 65-year-old, depending on portfolio withdrawals, may need more balance. The time horizon changes the risk. This is why simplistic advice fails. It ignores the person. Good investing is personal, not because the market changes for you, but because the consequences of volatility differ based on your life. Now, let us talk about buying the dip. Buying the dip works only if the asset is fundamentally sound and the investor has liquidity. Not every dip should be bought. Some dips are value opportunities, some dips are warnings. A declining broad market is often a long-term opportunity if the economy and corporate system remain intact. A declining single sector may be an opportunity if the long-term demand remains strong and the decline is valuation-driven. But a decline caused by structural impairment should not be blindly bought. If the thesis changes, you must change. This is why analysis matters. AB does not mean buy everything forever without thought. BTD does not mean every falling asset is a bargain. It means that when high-quality assets you want to own for decades fall because of market cycles, fear, or temporary dislocation, you should have the system and courage to buy more. That is different from catching falling knives in broken assets. The distinction requires judgment for broad ETFs. The judgment is easier than for individual stocks because the ETF contains many companies and can rebalance over time. But even ETFs can be overconcentrated or thematically vulnerable. So the principle remains, know what you own, know why you own it, know what would change your mind. Now, if you are trying to beat the SP 500, you must also accept tracking error. Tracking error means your portfolio will not behave like the benchmark. If your goal is to beat the SP 500, you cannot expect to match it every year. You may underperform for long periods. That is psychologically difficult. People say they want to beat the market, but then they become upset the first year they lag it. You cannot have outperformance without being different, and being different means sometimes looking wrong. That is one of the great emotional costs of active tilts. If you cannot tolerate looking wrong, stick closer to the benchmark. There is no shame in that. The worst strategy is wanting to beat the market while emotionally needing to track it perfectly. That combination makes people abandon strategies at the wrong time. So be honest, if you want simplicity, choose simplicity. If you want higher return potential, accept the discomfort that comes with higher return potential. Do not lie to yourself. The market will expose the lie. Now let us bring this into a practical mental model. Imagine 3 layers. The first layer is the foundation. Emergency fund, no high interest debt, consistent income retirement account access, low costs, long time horizon. The second layer is the core broad market exposure, like the SP 500 or total market. This is the engine that captures general economic growth. The third layer is the tilt growth. Technology, defense, momentum, semiconductors, Nasdaq 100, or other specialized exposures. The tilt is not there to replace the entire system. It is there to increase return potential if the investor understands and accepts the risk. If the tilt grows too large because it performs well, rebalance. If the tilt underperforms but the thesis remains intact, remain disciplined. If the thesis breaks, exit. This is a system. Systems beat impulses. The final lesson is that market cycles create opportunity for prepared investors. Recessions will happen, crashes will happen. The market has experienced many of them over the last century and still compounded wealth for patient owners of productive assets. The problem is not that crashes happen. The problem is that people are surprised by them. They build portfolios that only work in good markets. Then a bad market comes and they sell. The prepared investor expects downturns. He holds cash reserves. He invests consistently. He uses downturns to buy more if appropriate. He understands that volatility is the price of long-term return. He does not need the news to be good. He needs the long-term thesis to remain sound. That is how wealth accelerates. Crashes create millionaires because they transfer assets from forced sellers and frightened sellers to prepared buyers. That sounds harsh, but it is true. The person with liquidity and courage buys from the person with fear and no plan. Which side you are on depends on the system you built before the crash. So yes, studying ETFs that have beaten the SP 500 can be useful. VU can teach you about growth. XLK can teach you about technology concentration. PPA can teach you about defense spending and geopolitical exposure. SMO can teach you about momentum. SMH can teach you about semiconductors and AI infrastructure. QQQ can teach you about large non-financial growth companies. But the real lesson is not the ticker symbols. The real lesson is how compounding, risk, concentration, behavior, and time interact. If you understand that, you can make better decisions. If you do not, you may simply chase whatever performed best last decade and then abandon it during the next painful cycle. That is not investing. That is performance chasing. A principled investor does something different. He respects the SP 500 as a foundation. He studies possible tilts. He sizes them carefully. He keeps costs low. He maintains liquidity. He buys consistently. He buys more during dislocations when the thesis remains strong. He accepts volatility. He thinks in decades. He does not blindly trust anyone. He does his own work. That is the path, not guaranteed, never guaranteed, but more coherent than chasing headlines. And in markets, coherence matters because your returns are not determined only by what you buy. They are determined by what you can hold, how you behave under stress, what you pay in fees when you panic, whether you keep buying, and whether your system survives the cycle. If you can improve each of those things even slightly, the compounding effect can be enormous. That is the deeper meaning of trying to retire 10 years faster. It is not about finding one magic ETF. It is about building a machine that compounds better, leaks less, survives longer, and behaves more rationally than the average investor. The SP 500 may be enough for many people. For others, thoughtful tilts may add return potential, but the true edge is not only in the fund. The true edge is in the discipline to keep buying good assets through fear, to avoid selling during crashes, to understand what you own, and to let time do what time does best. Time turns small differences into large outcomes. The investor's job is to stay in the game long enough for that to happen.